Hello, everyone, and welcome. This is part five of the Finance for Travel Agents. If you've missed all the previous four sessions are loaded, you can find them on our YouTube channel. You can find it on the main page. We talked about business structure. We talked about merchant accounts. We talked about commissions, a little bit of taxes in the last session. And in this session, we are going to talk about retirement planning for business owners. We're going to touch, this is going to be a little bit basic for some. If anyone has any questions that they're live and they want to ask, feel free. We are going to talk today again about retirement. So, why do we need a retirement account, or pretty much why is it for? Why do we need it? The advantage of having a retirement account is we can save now with a few benefits, and we are going to talk about the benefits in terms of taxes, in terms of options, and save for the future. Right, so retirement accounts make savings way more efficient because they have tax advantages. Everything that you save within that account, you don't pay taxes on it for the most part. You do have the option when you are saving the money, when you are putting money into that retirement account, to deduct it from your total income. So let's say, for example, and we did talk about taxes in the last session. Let's say, for example, you make $50,000. You can take 5,000 off that 50,000, put it pre-tax, before taxes, into your retirement account. So right now you are only reporting on $45,000 in spent, which means sometimes, as you probably know, there are tax brackets. So you can manipulate your gross amount and reduce. So let's say you're making $75,000 and 70,000 is the threshold for the 12% or 11%. And then you go on to the 22%. You can take that difference. Instead of paying 22% on that portion, you can put it pre-tax into your retirement account. You reduce your taxes right now. Everything grows in that account. Now, in that account, you have options for growing it, um, what we call tax later, pre-tax, so tax deferred bucket. So if you take and you create some sort of an IRA, independent retirement account, or you create a 401k, which is a fancy way of having an employer sponsored retirement account, and you as business owners, as travel agents, and you own your own business, you can open yourself either a 401k, whether it's going to be a SEP IRA, a solo 401k, or if, again, we talked about business structure, if your company is an S Corp, you can even open a regular 401k. You can even do a Roth 401k, which we're going to talk about a little bit. But all of that money is, that bucket is a pre-tax bucket. So you take all that money, as I've mentioned before, and you put it before you pay taxes on it. It's the full amount. Instead of, again, getting $50,000 in income, you pay taxes on it. Let's say you pay 10, 20%. Whatever is left, you then go and invest. In this specific situation with the pre-tax, you go and you invest that money before taxes came out. So another option is to do it post-tax, which something that is called a Roth IRA or a Roth 401k. You are allowed to take the money. Again, we did $50,000. We paid taxes on them. We got the net into our bank account. Then we took that money and we invested it in a tool that is called a Roth IRA, or again, a Roth 401k. There are limits to how much you can contribute in that aspect because this is a very, very strong tool. In 2026, you're allowed per person $7,500, so $7,500 if you're under 50, to put money in there. The advantage of that account is that everything that you make, everything that grows in that account will be completely tax-free forever. And forever is even if you pass away and you leave that account to your kids, then this is forever tax-free, everything that is gained. So this is also a very, very strong tool. It has limitations as to who can contribute to it. If you're making too much, if you're married and fighting jointly, if you need to make at least
Oh, shit.
$250,000. If you are making more than that, then there's some restrictions. There are options. I don't know if you've ever heard it to call backdoor IRAs and backdoor Roth and things like that. I am not going to get into it, but you do have the option again, as long as you're making as a household under about $250,000, you can contribute into a Roth. Again, a very, very important tool. And I'm going to show a little bit about the growth and information about retirement. So, retirement, again, there are multiple types of retirement accounts, whether you're doing it as personal, so a traditional IRA, independent retirement account that you can build for yourself, a Roth IRA, just talked about it, but again, it's an independent retirement account that you can create for yourself as an individual. If you are a company, if you're an S Corp, you are allowed to open a 401k for your employees, which you are one of them. Again, if you're an S Corp. I'm not going to touch up on a 403b because it's less relevant to us. But the SEP IRA and the simple IRA, that's if you're not an S Corp, you can definitely do this. The advantage of doing these as a small business that you can also contribute money as the employer. You probably heard online and people talking about why to do a 401k. There's a match for my employer. When you are self-employed, you have the opportunity to have two hats, one as the employer and one as the employee. So you can do a 401k contribution from your business, again, depending on your business structure. But the advantage, if you are doing some sort of a match and you are giving money to your employees, which you are the employee, the company writes it off as an expense, kind of like giving you salary, and you take the entire benefit to into your retirement account. So this is a very, very strong tool, and that's one of the main reasons to switch to an S Corp company. Allows you to maximize way more in contributions. Let me see with the 401 contributions. Okay, so we talked about contribution limits to an IRA and other contributions for sorry, let me just move this because it's in the way. Sorry. Yeah. All right. So contributions to Roth, we talked about it. Contributions to a regular IRA and 401k, you have a limit of 24,500 in a year. So you still have your Roth, which is 7,500. Then you can contribute 24,500. That amount, this one will deduct the amount as we talked about, will deduct the amount of what it is that you're paying. So let's say you make $100,000 or $50,000, you can take 24,500, put it into a 401k, and that will take it. One of the advantages are that you won't, you're technically taking it pre-tax, so you're not paying taxes on that amount. It reduces from your overall. You can reach a point where you're technically not paying taxes at all. Again, really depends on where your income is. The disadvantage of doing a regular 401k or a regular IRA is all that money that is there is then tax deferred. So you're going to pay taxes on them later. And we'll talk about when is later, but you are going to pay taxes on them later. So again, you can take it and put even more, 24,500. Um, I would say that really depends on where you are in your life or your age, how much you already have saved for retirement. You may want to maybe accelerate, put a little bit more, put a little bit less. There are a lot of ways to look at it. Probably should have mentioned at the beginning. I did in the when you signed up, but this is not a financial advice. So you should reach out to a financial advisor or your CPA or someone who will help you. This is just for educational purposes. If you have specific questions, I can try and answer, but I probably recommend that you reach out to a financial advisor or a retirement planner that will take a look into your individual situation and they can make recommendations for you. Again, with the 401k, the employer can also make contributions. So you can do 24,500. Your employer, which is you are also the employer. You can contribute up to 24,500. There are limits as to how much the company can contribute, which is it's normally about 25% of their profit. So if company makes $100,000, your agency makes $100,000 in pure profit. Some of it goes as your salary, as your W-2. Part of the rest can be as a 401 contribution. Again, I'm hoping I'm not confusing people, but I would say this is a little more advanced, but you do have the option as the employer to also give yourself employee benefits. Again, advantage is that you can write all of this amount off your expenses as the business. The goal or part of the goals is to reduce your current income by showing more expenses, legitimate expenses, and then you'll pay less in taxes now. Now, what happens? So some of the things that people do is they open a retirement account, they pull money in there, but then they do nothing. Like they just put the money in and the money doesn't grow. It just sits there. So the second part of the investment, and we are going to show it in the next session, that should be next week, is actually how to actually invest, how to actually do something with that money. So
That's the
first,
one I need.
I will be here, so please sign up and definitely we'll go into that. I will show a few options, but in general, what you want to do is fund an account. You need to decide where you want it. And you know what, something that I haven't talked about when we're talking about retirement with the accounts is the taxable now. Some people may say, hey, we will talk about I don't think we talked about the when you can withdraw from a retirement account. We'll talk about it. But another option, which some people might say, hey, I don't want to take the money right now, put it into an account for retirement. And I don't know, I'm 30, I'm 40, I'm 50. I don't want to have it there for 20, 30, 10 years. I might need the money now or tomorrow, or I don't know. I wouldn't recommend investing if you need the money tomorrow, but normally when you're investing, you want to look at the long term. So a few years at least. If you don't have a few years, then there are other options where to put the money. I wouldn't invest it because as an example, last Friday and earlier today, stock market went down a lot. So if you pull it at a bad timing, you can lose money. So again, brokerage account is also an option. You can just put it in a regular account that is not an IRA or a 401k, and you can invest that. We will probably touch up on this in the next session. But again, when can you actually retire? When can you take money off retirement accounts? As a general rule, not before age 59 and a half. Okay, so you put money, it doesn't matter if you're sick. My kids, they're 15, 17, they already have retirement account that I opened for them. They can't touch the money. There's some exceptions. But they can take out the money until they're 59 and a half. And only at that time they can start taking the amount. Anything that is in a tax later account, when you pull it out, is considered regular income. So it's kind of like a payroll. It's like you're getting income. You are paying taxes on it as, again, as an income. State tax, government, like IRS, you are paying regular taxes. On brokerage account and other accounts, you only pay capital gains tax, which again, completely different story. We can touch up on it if anyone has a specific question. I would say it's advanced. I don't want to confuse people too much. But in general, everything that is pay later, tax later, then you can take it out starting 59 and a half. The IRS and the government actually wants you to take the money out because they want their taxes, because you haven't paid taxes on this for 20, 30, 40, 50 years. I don't know when you started, but you haven't paid taxes on this and we want money. So starting at age 73, there's required minimum distributions. So depending on how much money you have there, at age 73, the government makes you take out money and pay taxes on it. So there, again, lots of options as how much. Sometimes when a person reaches a really high amount, which is a good problem to have, this is when they start doing other things in it, rolling it into doing Roth conversions and things like that to avoid paying taxes later, because again, the government makes you at the age of 73 take out money. Also, we talked about the Roth that is never, never, ever tax, even if you die and you leave it to your kids. This one, when you pass away and you leave this to your kids, they have 10 years to take the money out. So they'll have to pay taxes on it. The government wants their taxes. So everything in all these buckets and these types of retirement accounts, they are really important for you to understand and know. That's why I put the bucket on, because that's how I look at it. It really depends on if you have all three buckets, then you can manage and you can do way, way better in terms of you can decide how much I'm taking from my pre-tax and how much I'm taking from my after-tax to make sure that I don't go over a certain threshold and I don't need to pay so much taxes. Now, again, when we put money into any of the retirement accounts or even a brokerage account, we can decide whether we want to put it in something that's called a growth stock or a dividend stock. The difference is, again, growth is a company. What's a stock? A stock is a portion of a company. Meta, Amazon, Tesla, CVS, Chevron, any kind of company, Eli Lilly, any kind of, medical, pharmaceutical, financial, any kind of company, they are publicly traded companies. They issue stocks. A stock is a X percentage from the company. When you buy a stock, you are technically part owner, a very, very small part owner. And then the company either says, we are going to give dividends. I'm a big company. I have a monthly report or quarterly report. We made in the bank $100 million this quarter. What I want to do with $100 million, I want to distribute it to my investors. I am going to take 50% of the profit and we are going to divide it as dividends. We're going to give it back to all of our investors. We have 50 million stocks out there. We have 50 million profit. We are going to give $1 per each stock that is out there. So if you own 100 stocks of a specific company, at that point you get $100. You can take the $100 and you could say, I want to reinvest it in the company, or I am taking that as income. I am in my 60s, 70s. I stopped working. The dividends that I'm getting from these companies are technically my income. I'm getting a check every month, every quarter, depending on the companies, of dividends. That is one option for you to invest in your portfolio to receive dividends. The problem with dividends in general, let's say the company, the stock was $100. Once they give stocks, the company is worth less. So it goes down, let's say $90. So whatever you got as dividends back, the stock loses a portion of its value. But it then goes back again to 100. You get the $10 back, and then it goes back to 90. So hopefully it always keeps around the same amount or maybe even grows. And then there's dividends. A growth stock is normally different because what they do is they don't give dividends or very, very small dividends. They take all that money and they use it to grow the company, get more employees, maybe buy another company, buy equipment, uh, grow and grow and grow. Again, like let's say Tesla or Facebook, they don't necessarily give dividends. They will buy other stuff and other companies that will grow, they'll invest, and then that stock grows significantly higher than a regular one that is mainly dividends. Okay. Um, we're talking here about individual stocks. Okay. We talked about what is a stock. Stocks in general, when you purchase them, they're very, very volatile. They're, if you invest in one specific company, you are what we call not diversified because you put all of your eggs in one basket. You are, if tomorrow something happens with the company that you really, really like and you have 10,000 stocks of, something happened and it drops 20%, 50%, whatever, you lose a lot of your money. So what people do is they invest in ETFs. They invest in a portfolio of accounts. For example, when people are talking about the market, the US market, they are talking about the S&P 500. The S&P 500 is the top 500 companies in the US. Some of these companies are global. Again, Apple, Amazon, again, Tesla, Meta, Apple, all of these companies, they're global, but they're technically US companies. So the S&P 500 is the top 500 companies in the US, companies that are growing, companies that are showing profit. It's an ever moving ETF, a fund that if a company is doing bad or good, they will take them out or bring someone else instead. There are companies who are entering and leaving the S&P 500 almost every quarter. Okay. This is considered in a lot of markets, this is considered medium risk. Even I wouldn't say low risk because there is a risk. There's always a risk with all of these, but the S&P 500 grew on average for the last 100 years. It grew by 10% every year. So there's growth. If you're looking at the long term, then the S&P 500 grows by about 10% every year. Okay. The other one that is significantly in growth, that's the NASDAQ. NASDAQ is again a combination of a few companies. This is 100 tech companies. These are the non-financial stocks that are in the S&P 500, we'll call it. So the 100 large companies that are not banking. This is mostly tech. There's a lot of tech companies that are in here. Okay. So you will find a lot of companies that are in the S&P 500 here as well, but this is considered a more volatile investment. It's way more in growth. And if you, I think I had, let me see if I have. Um, Let me see if I find it. I had a QQQ projection for the last. I believe it started in 2006. It grew by thousands of percent. So it's a really really a good growth tool. But let's continue. I'll show it later. So one really important thing in investments, besides putting money in and picking the right, we'll call it stocks or ETFs, which is probably the way to go, a big like a mutual fund or a fund that is managed in a way, is also time. Because something that is important in any savings or anything financial, even on the other side, even when mortgage, there is something that is called compound interest. So if you invested $1,000 this year, at the end of the year, you will have $1,100. So next year, when you are looking at the 10% that you're going to make, let's say again you have an investment that is going to make 10% every year. On the first year, you had $1,000 there, you made 10%, you made $100. Now you have $1,100. So the following year, assuming you didn't even add anything, you're making 10% on your initial investment, which is 1,000, plus you're making another 10% on the 100 that you made. So instead of making just 100, you're making 111 and then 110. And then the following year, it just grows and grows and grows. And in general, if you are at a 10% annual return, roughly every 7.5 years, your money doubles without putting money in at all. Okay. And if you are putting money in, then it just grows and grows. If you're investing $500 every month, okay, this is the projected growth. This is 5 years, this is 10 years, this is 20, this is 30. If you have a child, or maybe you are lucky enough to be in your 20s and you can invest $500 every month from now for 30 years, it's only 500, again, depending if you can afford it or not. And this is only 10%. Sometimes it grows even more. You will be a millionaire at the end of the 30 years. Okay. If you start at the age of 25 and at the age of 55, you will have close to $1.2 million, assuming you're not adding anything else. And assuming you're not starting with anything. Okay. Now, if you want to take out money before the age of 59 and a half, there are some options where you can take money. If you put it in a Roth IRA, right, I hope you can see my slide. If you're in a Roth IRA and you take out the money that you put in because it's money that you already you pay taxes on them, you're good. Like you can take money out. I wouldn't recommend it, but you can take money out again. But it is for someone who's going to say, "Hey, I'm in my 30s, I'm in my 40s. I don't want to put it there for 20 years. I might need it in 10 years. I don't know what's going to happen." So if you're in a Roth IRA, remember you can put up to $7,500 every year. The growth, the income, the profit, you don't want to take out early because you're going to pay a penalty on it. But the principal, the amount, the initial investment that you put, that you already pay taxes on them, because this is post-tax investment, you can take out. But if you took out the money, you can never put the money back in. Again, you're limited to $7,500 every year. So again, wouldn't recommend it, but you do have the option. There are options for first-time home buyers. There's higher education if you're saving for your kids and they want to take money. There's a couple of options that you can do. You can also you can take money out of a 401k and you have to pay penalties. You'll pay 10% penalties. You'll pay if you're taking out gains, you're paying taxes on the gains. There's a lot of stuff. I wouldn't recommend taking money out of your retirement account unless it's a last resort. All right. So I wanted to show. Let me see. I think I had. Let me see. I want to jump into model, a finance model. Let me see if I have it. Go to. All right, let me share this one. So, for example, we talked about the QQQ, which is the NASDAQ, since 2006, so 20 years back. It grew by 1,836%. So if you've put $1 20 years ago, you now have $1,800. If you put $10,000 20 years ago, uh, you now have $193,000 from $10,000. So, and normally what people do is or what you should do is not just put money now, like, and then let's save it for 20 years. This is something you want to put as, treat it as a bill. You work on your, you work on your income and everything. Every money comes in, money comes out. You have bills, you have your mortgage, you have your insurances, and then you have a little bit left. You want to assign each and every dollar to something. So at the end of the month, you still have $100, $20, $500. You want to take a portion of that, maybe a portion of your business gains or a portion of your pure profit, and you create a bill. And that bill is saving for retirement. Start small, and then you can, and we are going to talk about the actual investment, how to start investing next week. You put it as an auto bill, it just deducts, and it's a bill. It's now a new bill, but this is a bill that will, in 5 or 10 years, is going to be an amazing drive to grow your business and to grow your personal wealth. Um, I can tell you that I personally, I just turned 48 last like 2 weeks ago. I started saving for my retirement around the age of 40. So considerably late. I almost had nothing 8 years ago. When you start and so I would say it's almost never late to start, but you can start if you're in your 40s, you can start in your 50s. When you get into your 60s, it's a little bit harder, but you can maybe start thinking about maybe saving for your kids or your even grandkids. If you put $20 every month for a grandchild and they're 5 and they're 10, at the end, they will become millionaires with the growth. Money that just sits in your regular accounts makes nothing. Makes even high yield saving accounts, which right now makes about 3.74%, is not a lot when you're thinking about inflation, and inflation is roughly about 3% a year. So start thinking about it. I would recommend, if you don't know your budget, go over, see how much you have left at the end of the month, at the end of the year. Think about the 7,500. If you can contribute everything to your Roth, so 75 divided by 12, it's $625 a month. For some, it's a really large bill. They can't. Start with 100, grow it to 110, continue 150. Once you start seeing the money grows, it's magic. You will eventually see that your money grows way more than what you can put in. At this point right now, I am probably making more than twice than what I contribute towards my accounts because the investments just grow on their own. Okay. Again, I'm hoping that this is not too complicated. You can go back and re-watch this again. It really depends on what type of business you have and what type of business structure. So go back to the previous sessions. They're all loaded on the website. You'll be able to see them. I will post regarding, I think I should have it next week, Tuesday, 4:30 p.m. Eastern, regarding investing. Please join me. I will probably show something like a Robinhood or something like a Fidelity, something really simple, how to open, you'll see how simple that is. I think in the next few weeks, I even will do like an auto set for $5 a day. And we'll see. Maybe we'll do once a week just to see how it goes and how it grows, and maybe it gives you some sort of an incentive to open one yourself. Again, sometimes $5 a day. I don't know if you're spending it on coffee every day or spending it on stopping on the way to work and buying a drink or something. Think about it. It will help and make your financial life easier. That's it. That's it for me. I hope this was educational. I hopefully will see you guys next week. Bye, everyone. Drive safe.